Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.
Hello, I'm Michelle Makori, and this is Kitco News coming to you from the New Orleans Investment Conference. The U.S. Fed has left interest rates unchanged, largely as expected, for the second time in a row. Fed Chair Jerome Powell saying that while progress has been made on inflation, there is still a long way to go. Powell also focused on the resilience of the U.S. economy, citing a strong labor market and third quarter GDP that came in well above expectations at 4.9%. Well, here to help us analyze what we heard from the Fed, what this means for the economy, for the markets, and of course for gold, is Rich Checkan. Rich is the president and COO of Asset Strategies International. Good to have you with us, Rich.
Good to be back, Michelle. Thanks for having me.
All right, we have lots to talk about, but let's focus on what we heard from the Fed. As expected, holding steady at 5.25% to 5.5%. I'm going to run through some of the highlights from the statement as well.
Were there any?
There were certainly some highlights. Powell saying that the full effects of policy tightening have yet to be felt. The economy has expanded well above expectations. Supply and demand conditions for labor continue to come into a better balance. The process of getting inflation back to 2% still has a long way to go. A few months of good inflation data, only the beginning of what it will take. That they're attentive to recent data showing resilience in growth and labor. That data could warrant further tightening of monetary policy, that they will continue to make decisions on a meeting-by-meeting basis, and that reducing inflation is likely to require a period of below potential growth and labor market conditions softening. And then what everybody was waiting for in the Q&A section, Powell said that the Fed is not even looking at rate cuts down the line as they need to get current monetary policy right. So, what was your main takeaway from what we heard, Rich?
I think he's trying to talk down inflation. That's not going to work. My gut feeling, and I fully expected a pause, continued pause here today. I kind of expected again in December. And as long as humanly possible. I don't think the Fed can go much further. I've said this often. I think last time we talked, I said the same thing there.
But that was a while ago and you were wrong on that one.
Well, actually, our last interview, right before Freedom Fest, I want to say it was, I thought they were at the end of their rope, and they're very close to the end of their rope. Maybe they have one or two left in them, but Michelle, they can't service the debt. The debt is $33.5 trillion. They can't pay the interest on that right now. They can't go much further. So I think what Chair Powell is hoping is he can talk tough long enough. That's the higher for longer. At least for longer, we're going to stay at these higher rates so that inflation eventually comes under control. But I don't think he's got the ammunition to make it come under control at this point.
Well, that's a whole separate conversation as to whether the Fed can actually tame inflation. Came in at 3.7% core inflation, at least if that's what the government data is telling us.
Yes.
So they've paused in the second time in a row. If they pause in December, that would be 3 pauses in a row. Would you feel that the Fed is done at that point?
I think they're done right now, but they're hoping to be able to continue to be done and have inflation follow the script, if you will. The problem is, and I know we've talked about this before as well, Powell can't solve this alone with interest rate manipulation. Congress needs to stop overspending. And right now, with what's going on in the world, overspending is going to continue. And there's no appetite to cut the budget, cut the deficit. There's no appetite in Congress to do that. So Powell's fighting with one arm, and he can't win this battle.
Right, and we'll talk about the geopolitical situation, but obviously that is requiring a potential big amount of spending from Congress.
And the money will be spent. Make no mistake about it.
Let's focus on what he said with regards to the economy before we get into the geopolitical conversation, because he did acknowledge that the economic activity was strong in the third quarter. That was an upgrade from the September meeting when policy described it as a solid pace of growth. They noted that job growth has moderated. That was compared to previous statements when they said it slowed. And we had GDP at 4.9%. Expectations were for 4.7%. Consumer spending is looking resilient. And the jobs numbers are looking pretty solid. We had the JOLTS report from the Labor Department earlier this week. They show layoffs dropping to a 9-month low, 1.5 job openings for every unemployed person in September. So we are seeing some strength. What do you make of this resilience that we're seeing in the economy? Are these figures really reflecting what's going on?
I think they're reflecting what's going on, but I don't think they're interpreting them properly at the Fed. And I'm not an economist, so hats off to them. They may be right and I may be dead wrong. But the first thing I look at is the GDP. Okay, massive amount of that figure is public spending, not private. And that's not what you sustain an economy on long term, my personal opinion. I think you need the private sector kicking in hard, and right now it's public spending that's driving this train. The second part is he talked about them underestimating the strength of the balance sheet in the individual households, right? That they didn't gauge how much savings was there, and therefore didn't expect that consumers would continue to spend and spend more than they have in the past. I think the reason that those numbers are higher, that there's more spending than in the past, is the middle class is buying what they need. They're buying their necessities, and really nothing more. But the cost of those necessities is higher after 2 years of inflation than they were. So they're buying the same amount of things. It's just costing them more money to do it. And that's why I think we're seeing over $1 trillion in credit card debt. People are now, they can't tap into their home, right? Home equity is off the table because if they refinance, they go from 3% to 8%.
Yeah.
They're not going to do that. That's done. That source of financing is over. They're going to their credit cards next. When they're maxed out and they've got double-digit interest rates, that's over. And what we're starting to see, I could tell you from experience here as a retail precious metals dealer, we're seeing middle-class investors selling off gold, a liquid asset. Not completely, they're not eradicating their positions, suggesting that they're happy with this price. They're selling off enough to cover short-term needs. So these are all suggestions that the households aren't as strong as Chair Powell and the Fed think they are. And then the last piece, the labor market. As things recede in an economy, the labor market is the last to feel it. Everybody tries to deal with things as best they can, and eventually business say, I can't do this, and they start cutting payroll. That's going to be the last thing to happen, but I think it's coming. I don't think the economy is as strong as he suggested.
So a lot of these are lagging indicators.
I do believe so,
Well,
yes.
he did say as much that they will continue to make decisions on a meeting-by-meeting basis in light of the uncertainties and risks of how far we've come, that the committee is proceeding carefully. I mean, how far we've come is 525 basis points in about 18 months.
It's very far, very fast.
Very far, very fast indeed. So even if they pause, and we don't raise rates anymore, can the economy actually handle this longer, this higher for longer, or even steady for longer?
Yeah, my belief is the Fed has broken the banks' balance sheets, and they're breaking the back of the middle class right now. Okay, honestly, it's torture for me to listen to 45 minutes of Jerome Powell in a Q&A. When he starts off saying that we feel your pain very deeply and we're doing our very best to get things back in order, when I know full well that they were a big part of the problem that created the pain, right? And have misdiagnosed it and mistreated it for so long. The bottom line is they're breaking the middle class, and I think they've already broken the bank's balance sheets. There's so much unrealized loss on bank balance sheets right now that will eventually come due. And they talk about lagging factors. When they go to refinance this debt, that's when it all hits the fan.
Right. If we take Powell at his word, which we learned not to after he said inflation was transitory, he is still maintaining that the banking system remains sound and resilient. But I
don't know how you're judging that. I mean, honestly, Chair Powell, please show us the figures and show us the stress tests and show us, you're not counting an unrealized loss because of they're changing the way they categorize it on their balance sheet. But they changed the way they categorize it on their balance sheet because it is a real loss. Bond cycles are long, and I don't think that's coming back anytime soon. That's just capital that's evaporated from the bank balance sheets. And where does the bank get the capital? From you and me, the depositors, right? I think damage is done, and I don't think it's fixable.
Right, and as we just touched on, that with a debt of $33.5 trillion, servicing that debt at this level for the government becomes a really big problem.
I don't know the figure, but it's going to exceed the defense spending.
I think it's about
$860
$860 billion just to service the debt. Yeah,
and we haven't even capped the debt.
Right. Well,
we kicked that can down the road to after elections because it's
speaking of kicking cans down the road, one that was kicked was the government budget, which was kicked to November 17th. That date is fast approaching. It was one of the risks that Powell highlighted in the Q&A section as something to watch out for. Do you anticipate a government shutdown come November 17th?
I think they're going to kick the can down.
You think they'll come up with some kind of deal?
Come up with something, especially with everything going on in the world. They're going to come to some sort of an agreement to spend more money that we don't have. And their hope was that we could kick this down past the elections, so this political hot potato wouldn't influence anybody already incumbent in the U.S. At every level. But I think it's backfiring on them, to be honest with you.
Well, let's talk about the reaction of gold to this.
Yeah.
We had gold down about $12 as the Fed chair was speaking, recoup those losses for the day. So practically, gold reaction to this flat. What do you make of that?
I think the gold market saw exactly what they expected to see. Nothing but words, no action here. And again, I think Powell's going to continue that as long as he can get away with it, because he really doesn't have any more ammunition. I and others have been saying for a long time that he can do no more damage, or not much more. And they fully expected a non-event today, and that's what we got. So gold shouldn't react to that. It's reacting to other things, I think, more significantly in the marketplace right now.
All right, so let's talk about that. I mean, we did see gold pop after the terrorist attack by Hamas on Israel, October 7th. Gold sort of taking its place as a safe haven asset in response to that and in response to conflicts in the Middle East that may spill over. So far, the conflict has been mostly contained to between Israel and Hamas, Israel and the Gaza Strip, although there has been some minor involvement from Hezbollah, another Iranian-backed terrorist proxy in the north that has shelled some positions, but for the most part, it has been contained. Geopolitical risks was something that Fed Chair Powell was also being asked about. His comment on that was that they're monitoring the Middle East. He's mindful that if the war does spread, that could impact oil prices, which of course is significant for inflation. Oil hasn't reacted too much to this, he said. It isn't clear at this point that the conflict will have economic impact. It may or may not matter to the FOMC as an economic issue.
Sure.
So is gold pricing in that same sentiment?
To an extent, but I think in a different way. I honestly don't think that what we're seeing here with gold is a flow to a safe haven. I think we're seeing more of a crisis speculation trade. Gold shot up from October 7th to its high, about $160 an ounce. That is significant. It made that new high just barely above 2,000, but I keep going back to this. The investor is really not in this market. It's not sustainable here when all you have propping up the gold price are central bank purchases, which are very strong, and you have people trying to benefit from in gold through the crisis. I think some of them got stuck in that marketplace. Some of them are still hoping for higher prices, but I don't think these are long-term investors buying for wealth insurance.
All right, I want to break down a couple of points there. So you're really emphasizing the lack of retail investor interest. You're talking about mom and pop coming in and not buying gold coins and gold bars, but rather being forced to sell
They're selling here, not buying.
Is this anecdotal from your experience, or do we have a broader data effect to corroborate this?
Yeah, we're seeing this on the ground with our firm. We talk to other dealers. We're not horrible competitors. We talk to each other and share notes. Others are seeing the same thing. And World Gold Council came out year on year, coin and bar demand, which is what retail investors buy. That's what they buy and they put in their sock drawer or what have you. That's down 14% year on year. Investors are not in this marketplace. I think they have to be in this marketplace for sustained prices higher than $2,000.
Well, let's talk about the central banks, because as you quite rightly mentioned, central bank buying continues to be on a huge spree. In fact, according to the World Gold Council, we could hit a record again in 2023 for central bank gold purchases after hitting a record high last year.
That's a big record we hit last year too.
So, I mean, what do you make of that central banks have been ramping up their gold reserve purchases so dramatically? Wow. China, of course, leading the way there, but as a general trend.
This last quarter, Singapore and Poland, it's across the board. China is up there, Russia's up there, Turkey's up there. Folks you would expect to be buying are buying. But they're not the only ones. It's really broad-based from central bank buying, and they have the same concerns that we do as individual investors. They're worried about an asset that doesn't have some sort of a risk. It's not a risk asset. They're worried about storing value in times of crisis. They're worried about hedging against inflation. Some of the emerging nations that are buying gold are worried about de-dollarization, sanctions, things of this nature. So they're all resetting their balance sheets. They're shedding dollars right now for gold. And I think they're smart to do so, be honest with you, in the long term. To the tune, last year, 50 to 60 year highs, the highest central bank purchases we've seen ever, basically, since they've recorded data. And this year, first quarter, we exceeded. Second quarter, we kept pace. Third quarter, we pulled back a little bit, but we are still at or ahead of the pace of last year's 60-year record. Central banks are buying in a big way, and they are really what are buoying the gold price, in my personal opinion.
Right. Well, a lot of that has been driven by the so-called weaponization of the US dollar following Russia's invasion of Ukraine and the very aggressive sanctions and measures that the US government took, including kicking Russia off the SWIFT system. So we know that the BRICS, Brazil, Russia, India, China, South Africa, who have invited another 6 members to join, have been really trying to de-dollarize in the sense of using their own currency to trade as opposed to using the dollar. China is the central bank leading this big frenzy that we discussed. It's part of an 11-month buying spree. They bought so far, according to the World Gold Council, 181 tons this year, taking gold holdings to 4% of its reserves. Is this a big move towards de-dollarization? Is it an anti-dollar move? Or what is your reasoning, or what do you think the Chinese reasoning behind this move is?
I think the Chinese are very clear in what their objectives are. I don't think they've hid their motives. They want to challenge the dollar for supremacy. Now, between you and I don't think that's happening anytime soon. I don't think there is a currency on this earth that can dethrone the dollar anytime soon. But that doesn't mean they're not going to be working that direction.
Right, and there was speculation that at the BRICS meeting that took place in South Africa earlier this year, I believe it was August, that they would launch some kind of commodity-backed, common currency backed by gold. There was speculation that they would at least formalize discussions about it or make some kind of moves. That didn't happen.
Their act is not together. It takes a lot to bring all these disparate nations together and get them on the same page of music, if you will. I think they have a long way to go. It does not mean they're not working that direction. However, I just want to say, just so people know, that it's not just the enemies of the U.S. or of the dollar that are looking to hold gold and shed dollar reserves. We've pushed friends that direction too, right? If you're friendly with the U.S. right now, but you saw what happened to Russia, you're saying to yourself, okay, I'm on the good side of the ledger, but what if I do something and I misstep and I piss the U.S. off? now they're going to sanction me, or they're going to shut me off of the international, monetary markets. I need to make steps right now so I have an alternative if that ever happens. I think we've pushed friends and enemies away, but again, no time soon is the dollar being dethroned. And right now the dollar still is very strong, as is gold. I think they're both showing their strength as safe havens in the time of crisis.
So how does that play out? When you have a strong dollar, that's usually bad for gold prices, considering gold is priced in dollars. If geopolitical tensions continue to escalate, do you see a flight to safety in terms of the US dollar, in terms of US treasuries, to gold, to both?
I think we're going to see what we're seeing right now, which is a flow into both of them right now. It's odd with all this US dollar strength, high yields on treasuries, to see gold hold its position and in fact advance in position. So I think they're both being seen right now as safe havens in a time of crisis.
So Rich, earlier you were saying that you're seeing a differentiation between people buying gold as crisis speculators as opposed to looking at gold as a safe haven as we see geopolitical tensions potentially escalate further and further. What is the distinction there? What do you mean by that?
It's something I've seen before. So whenever there's geopolitical crisis, I don't like to have people chase the gold price, right? Because there are people that will just get in it to run it higher and then sell, okay? And I do think we saw some profit taking, a little over $2,000 an ounce to about $1,970 or whatever it is right now. So we saw a little bit of a sell-off. I think the crisis is enough to sustain the price here going forward. But I really think that it's speculation driven. You don't see a $160 rise in the gold price in 2 weeks just on safe haven flows, in my personal opinion. Saw similar things when the Twin Towers went down. All right, I was working that day at ASI, and gold at that time, I want to say it started the day trading about $270 an ounce, maybe $250. I forget exact numbers. That day, gold rose intraday $50 an ounce. That's significant at a $250 to $270 gold price. And we spent most of the day telling people, don't buy. They called us up, they wanted to buy because they were scared. That's natural. But we said, don't buy. Within a couple of weeks, it reverted back to 270, okay? Short term, you'll see these moves, and scared people and crisis speculators will jump in at that time frame. But I'm not a big fan of chasing prices higher in conflict. I also don't want to shy away from buying either. Just work your plan. Forget about what's going on around.
Arguably, when you see tensions like this, right, when you feel the fear of war, you feel the fear of escalation, that's exactly when you want a safe haven.
I think you already want to have it by then.
Pardon?
You already want to have it by then. Not just be buying it.
But as it is now, right? I mean, terrible tragedy. What happened in Israel with that Hamas terrorist attack, and then continues to develop as Israel retaliates against Hamas in the Gaza Strip. Even though Israel tries to minimize civilian casualties as it targets Hamas, we know that Hamas uses schools and hospitals and civilians as human shields. So very sad civilian.
Just saw it again today. Yeah.
Very sad civilian casualties, on both sides here. Does that not legitimately spur a need for gold? I mean, we were chatting a little bit about this earlier, but if you're in the Western world, in the United States, and you're hearing this anti-Semitic sentiment, right? This anti-Israel and strongly anti-Jewish sentiment, with people calling for the eradication of the entire state of Israel, does that not sort of trigger that response of, I need gold as a safe haven should there be another Holocaust? Or, when we're seeing Stars of David being painted on people's homes in Paris and France, does that not trigger the instinct of, I need gold in case I need to grab and go? And God forbid this escalates any further and it's a tragedy that we are where we are already. But you're saying you wouldn't encourage people to buy now. I mean, shouldn't they try and take some actions? I mean, people have been buying. I know people in New York that have sworn to never own a firearm are looking to buy guns.
So just to clarify,
So isn't this like a guns and gold kind of moment? Not to be callous about.
No, it is. Just to clarify what I was saying, I'm not a big fan of chasing the price higher, like fear of missing out type thing. Like it's going to get away from me. That's not why you buy it. If you have a need, yes, buy it. I guess my point is, I wouldn't shy away from buying. I wouldn't chase the price higher. But if you have a need and you have a plan, work it. And in a time of crisis, if you don't have your gold, by all means, you should buy some, if that's a concern. So there is some safe haven flow, but I don't see a $160 an ounce move in 2 weeks unless speculators are involved, in my personal opinion.
All right. Let's talk about the other geopolitical ramifications here. And of course, a lot of that is linked to oil, given the region, given that the Strait of Hormuz is right there. Should Iran somehow get involved in this conflict, they've attempted to block that before. 20% of the world's oil goes through the Strait of Hormuz. So much so that the World Bank has issued a warning saying that oil prices could soar to $150 per barrel if tensions in the Middle East continue to escalate, recalling the oil crisis of the 1970s when Arab nations limited their exports. So the World Bank fears we could see oil prices between $140 and $157 per barrel shoot up very quickly. So far, the oil market is not pricing that in.
Acting like there's nothing going on right now.
I mean, I know you're not an oil guy, but what do you make of that?
I absolutely believe that it could have a major impact, and Chair Powell kind of dodged that question today. But there's no question. I mean, everything that moves to market moves so with oil, one way or another. It will have a massive impact, not just on economies, but on every single product and market. It could be gold, it could be a tomato, it could be a ribeye, it could be anything just driving to and from work. It's going to have a massive impact if it goes that high, and that will feed into everything.
Right. If it goes that high, that means we've got arguably potentially much bigger problems on the horizon.
There's no question, because I think that kind of dictates that what's happening now is state players have entered their hats into the ring. And I think that sends oil through the moon. I think it could potentially be the one thing that sends gold much higher without investors getting involved.
That would be the trigger in terms of a geopolitical development that you see sparking a huge gold rally. And I will reference that you do have a military background. Yeah. I believe you were a captain in the U.S. Army?
That's when I left, yes.
Okay, so certainly have some credibility to weigh in on this.
Yeah, and my fear is we're heading that direction, Michelle. I was just listening to the sound bites today, and usually when politicians talk about a conflict or what have you, there's always some sort of wiggle room, right? It's like, this is our intent, but we're really hoping to settle this, as quickly as possible. Something they want a way out, they want a back door if they don't get what their desire would get them. Right now, the one side is looking for total annihilation of the other, and the other side is looking for total annihilation of the other. There's no fallback position. There's no place to save face. And that scares me.
Well, Israel is looking for total annihilation of the Hamas terrorist group, not of the people of...
True.
Not of the people of Gaza, certainly.
They're looking to eradicate Hamas.
Yes.
And Hamas is looking to eradicate all Jews. And that's a problem when your stated goal, there's no restraint in this conflict. There's nobody coming in saying, I'd be satisfied with something less. It's all or nothing, and there's no position to fall back to. That to me is a bit scary.
The Hamas and fellow terrorist proxies' position is the eradication of the entire state of Israel.
Yes.
When people chant from the river to the sea, that means from the Jordan River to the Mediterranean Sea, and that means wiping out the entire land. And it's very clearly in Hamas's charter that that's the agenda. So arguably does not give, Israel much room to back down. I believe their military objective is to rescue those hostages, those 200 plus hostages, women, children, and elderly, as well as some men that Hamas has kidnapped and hiding in terror tunnels in Gaza, and eradicate Hamas. I mean, if that military objective is achieved, this conflict gets contained. I mean, arguably a very challenging objective to achieve.
As long as cooler heads prevail, because the threat here is that a state player like Iran throws their hat in the mix, and then we start seeing dominoes fall, and that's very dangerous for world stability.
Is that the trigger if a state player gets actively involved?
I do think so.
I mean, because we have seen attacks against American bases in Iraq and in Syria, drone attacks, a couple of missiles, some missiles even shot at from Yemen. What kind of act from a state player really triggers, and certainly praying and hoping that this does not happen?
Yeah. I think it's armed conflict directly by a state player, not through a proxy. That's what needs to happen for this to escalate, and I hope to God it never does. But I'm a little concerned.
But just the threat of the conflict expanding could be dramatic for oil prices, right? Without necessarily a state player getting involved. So if you would have oil at $150, what does that mean for gold?
I don't know, to be honest with you. I really don't know. I hope we never find out. But I would think higher prices. Certainly if a state agency gets involved directly in the conflict, not through proxies, I see gold going up dramatically. We could see $2,200 an ounce, easy. But save that. Working through proxies, I don't see gold receding from 1975, $2,000 an ounce, but I don't see it going significantly higher unless a state player gets directly involved.
All right, well, let's certainly hope that that doesn't happen. And
I'd like to see gold rise for different reasons.
so the market is currently pricing in more or less that this conflict remains contained to the region. Let's bring in the Fed so we come full circle with this conversation. Powell insisting that they're not even thinking about a cut. What is the trigger from a Fed perspective that sends gold higher? Is it the first pivot? Is it the first cut from the Fed?
That's where I think it comes. Now, again, I think he's going to try to talk this thing down. He's going to hold rates as long as he can at these levels and hopefully gets the desired measurable outcome they've been talking about all along, which is 2% inflation, right? And wherever 2% came from was silly, but why we need 2% inflation, we could argue that on a whole nother program. But that's where they want to go to. And unless he goes there, he hasn't achieved his objective. So he's trying to talk it down longer, but I think he knows in his gut he can't go higher. So at some point, he's going to have to start to pivot. And I think that's gold's time to shine.
When it's the first cut, when it's any sign of a pivot?
I don't have the data in front of me on this, and I wish to God I did. But after rate cuts or rate increases, once they start to recede, there's a certain time period where gold reacts. It's not immediately, but the countdown starts at that point from the very first rate cut.
Okay.
Then it is time. If you don't already own gold and they start cutting rates, you probably ought to buy some.
All right. With that, what is your gold price outlook for ending the year 2023? And a lot of things can still happen, granted.
True. Assuming the conflict remains contained where it is right now, not saying that's good. I wish it was over. But if it stays where it is right now, I think gold stays where it is right now. I don't think it goes any further.
Does not reach an all-time high.
Not this year. I don't see it, not in 2 months.
We did hit one on the COMEX future earlier this year when it briefly touched above 2080, but no real all-time high reached this year.
I don't see it happening. Next year, if, as a lot of people feel, the Fed will start to cut rates, we'll probably see new all-time highs by the end of next year. But not first quarter, probably not second quarter is my guess.
So only into the second half of 2024 do you expect gold?
That would be the first, and that's assuming we start cutting rates.
Do you think, though, that people should be increasing their allocation to gold given all of this? And granted, you have a vested interest, but
I don't know that you should be increasing your allocation unless your allocation is lower than what it ought to be. If you do an analysis and you say, this is how much I need of wealth insurance in my portfolio, and you're not there yet, I think you should be buying it here and now. I don't know what you're waiting for.
all right, well, Rich, thank you. Some not so pleasant topics and thoughts that we had to cover today, but thank you as always.
We'll get back together on much nicer terms when the world is a little bit more at peace.
That would be lovely. Let's hope and pray for that. And all right, Rich Checkan, thank you so much for chatting with us.
Thanks, Michelle.
Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.